All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. I'm your host, Kyle Demian, and I'm joined here with my co-host, Renji Matthew. And today we're going to be talking about the Rockefeller method of building and preserving their wealth and how they've made it last over 7 generations. And they've used it, they've used a strategy and a method that I would say the average American doesn't know about and probably has never heard of. But there is a book that was written on it called What Would the Rockefellers Do? If you guys want to go in depth and learn more and, potentially learn how to instill it into your life, we're going to talk about the overarching strategy and how they've done it, how they've been successful with it, and, how it's lasted 7 generations. And we'll actually talk a little bit about the Vanderbilts and how the Vanderbilts actually had more wealth than the Rockefellers did 100 plus years ago. But the Vanderbilts, just 4 generations later, their wealth was basically diminished, while the Rockefellers has lasted over 7 plus generations. So, Renji, if you want to start us off, there's like really 3 main points or 3 main keys to this strategy that's allowed the Rockefeller wealth to last as long as it has. And why don't you go ahead and take us through the first one for us? What's the first strategy?
The first strategy is setting up a trust. So, what is a trust? Really, what I explain to people is it's another layer of protection for you as an individual, for your family, for your businesses, all of that. So, I'll talk a little bit about our trust that we have set up and how we have it set up and all that. So, we have our trust set up, and I'll tell you also this. If you set up a trust, if you don't have a lot of things going on, like a bunch of businesses and everything like that, it's not going to cost you that much. But if you have a lot of things going on, of course, the cost varies depending on how much the lawyer has to do. So, because I've talked to people that, like my parents, for example, for them, it cost them about $750 to set up. But they don't have a lot of things going on. There's just a few things they wanted to do. But I've also talked to people that paid $30,000 to set up a trust. But they had multiple businesses and everything. So to set all that up into the trust, it takes some time. But you can also do what we did when we first set up the trust. We didn't have a lot of businesses stuff. We just had a few things going on, and it didn't cost as much. And you can always revise that trust every year and update things as your businesses grow and add things to it or whatever you want to do, making changes to it. And depending on your lawyer, they might not charge you anything to revise it. Again, depends on how much the lawyer has to do. But so ours is set up where not in paper, we don't look like we own anything because the trust, what it does is it's all our businesses are set up under the trust. Our LLC is set up under the trust. So the trust looks like the owner of the LLCs, our businesses, even our life insurance policies. It goes to where whenever we pass away, it goes into the trust and funds the trust. Same thing with the businesses. With a trust, the difference between a trust and a will. A will is inside a trust. So with a will, you're just saying what happens with your assets when you pass away. Or you could talk about what you want to happen medically if something happens. In a trust, it has all of that. It has a medical power of attorney, financial power of attorney. We talk about in our trust what happens if we pass away and our son is underage. We have trustees set up. We have people. You can set up one trustee or a board of trustees to take care of all your assets when you're gone. And the good thing about a trust is it's a law-binding contract, so they have to follow that. And this is why the importance of telling multiple people in your family about the trust and all that stuff. Because if you just have one trustee and don't tell anyone about your trust, that trustee can take things and change it. But if they find out, they can get in a lot of trouble because it is law binding, right? But you want to. So in our case, we told our parents, we told both our families, and then we have Ezra's godparents. We've told them, our siblings, stuff like that. So there's enough people that know that it shouldn't be an issue, right? So, but going back to the biggest thing is the importance is the protection. So let's say someone looked us up, or someone wanted to sue us. they can only go after us personally. They can't go after our businesses or trusts, anything in the trust, because it's kind of like it's a separate entity. So it gives you that layer of protection over an LLC. It's just a multiple layers of protection. Anything
Yeah.
you want to add on to that, Kyle? I know I've been rambling on.
No, you're okay. That was a great explanation. How I kind of think of it is like us as individuals, there's going to be a day where we pass away, right? And when we pass away, if our assets are in our name, the and we don't have a trust or will or anything set up, the government necessarily doesn't know how to transfer our assets. So that's where like probate and estate taxes come in, because you're leaving your assets that were all in your name, and now they need to be transferred over to somebody else's name. If you put all your assets and or your wealth, inside of a trust, trusts can't ever die, because they have a board of trustees or a trustee, which kind of controls the trust and makes the decisions for how the trust is managed. Since the trust will never die, your assets are always protected inside of that and under that umbrella. Does that sound right, or was there anything I missed in there?
Yeah, no, you're right. Something I forgot to mention too. So I did mention our son in there, but we have it set up where, okay, so if we pass away before he's 18, a percentage of our assets would go to him at 18, if he decides to go to college, or if he decides to start a business or whatever. And then it has it set up where when he turns 20, gets this much or whatever. So you can control all of that, how you set up the trust. That way you're not worried about what's going to happen if you're gone. You can put all of that.
Awesome. So yeah, the first step, they established a family trust where they could all put their assets into it. And the second step that they did is they all took out a very large, like cash value life insurance policy on themselves. So when they do that, they make the owner and the beneficiary of the policy this trust. So what happens when you do that? Number one, we're all going to pass away one day, right? And then so when the Rockefeller started passing away, this life insurance death benefit, this large life insurance policy would pay out to the trust. So now the trust would get filled up with a bunch of cash, whether it's a multi-million dollar policy or probably, in the tens of millions of dollars, depending on how they structured it. But this large life insurance policy provides the cash flow that's needed for this trust. And with a cash value life insurance policy, you can actually start to build up what's called cash value, or cash inside of the account that you can use and that you can access. And that's the third main key to the Rockefeller waterfall method, is how they can access the money. So Renji, go ahead and take us through, number 3 and how they access it and what they can do with that money when they go to access it.
Yeah, so like I mentioned before, you can either have a one trustee or a board of trustees that decides how and again, you can set all those rules up when you first set up the trust. But you can have it set up where you're like, okay, I want them only to use this money to buy assets, or only a certain amount of it can go for college, or if they wanted to start a business or whatever it is. And they can use the money to buy liabilities too, but you can set those rules where you can say in the beginning when you set the trust up, and you could say, I don't want the money to use for any liabilities, only for assets. So you can do all that. That way the trustees have to follow that, and they can only release the funds to someone in your family for whatever you set the rules as. So the smart way to do it is, like Kyle said, all the life insurance policies fund the trust. Now that trust has all this money in there, and it's all tax-free because it was from life insurance policies. Now, anyone in the family, let's say if I was in the family and I wanted to go start a business, right? Now, instead of going to a bank, I can go to my family trust and borrow money from that and buy an asset or start a business or whatever it is. And because it's our family's trust, we can decide what the percentage is that they lend it out to me at, interest rate wise. Instead of going to a bank where you don't have control over that. I mean, I guess you have a little bit of control depending on your credit and all that stuff, but it's really at the mercy of the bank, right? So, but this way, it's all your family deciding how to do it. or whoever the trustees are. And you can make the interest rates as low as you want, or however length of time you want, and all that stuff. But the whole point is you can use it to buy assets, start a business, whatever it is, and you can use it as your own bank instead of having to go to an actual bank. And you're just making you just take it, repeat, rinse, repeat, keep making that fund in the trust bigger.
Yeah, for sure. And when you do that, like you kind of mentioned, there's no credit check, there's not any financial documents you necessarily have to do, which is what's required from a traditional bank, right? Going the traditional route. But most importantly, what this has allowed John D. Rockefeller to do, over the last 100 plus years, is preserve his wealth and to leave a lasting legacy. Where the Vanderbilts failed is they didn't have these type of standards in place, or they didn't have this type of structure in place to where, easily there can be one rotten apple in the family tree that comes around and they use all the money and they just splurge and buy stuff that, isn't producing income. It's not building a business. It's more like liabilities, cars, maybe a personal house, and things for themselves that just aren't continuing to build the family wealth, which is what John D. Rockefeller wanted to do. And that's why this system was set up in the first place. So, proper estate planning and proper life insurance planning using a structure like this is, probably the best way to preserve your wealth and to make sure that you can create generational wealth. And I know a lot of the times, people we talk to, that's one of their goals is to create generational wealth. But sometimes we say that, but we don't necessarily have a plan, or we don't necessarily have something in mind. So, I would encourage all of you, if you're watching this and you've said before that you want to create generational wealth, like define that. What does generational wealth mean to you? Because to one person, it could mean, leaving behind $1 million to your kids. To others, it could mean, hey, I'm going to leave behind 5 or 10 million. I'm going to create this family trust, this family bank, and I'm going to dictate how my heirs can use my money, my legacy that I leave to them. And that's how you can make sure that you're leaving a ripple effect in your family for, not just 1 or 2 generations, but potentially up to like 7 generations, which is what, John D. Rockefeller has done. So, Renji, did we miss anything? Or was there anything else that you wanted to cover today on our podcast about the Rockefellers?
No. I think we covered it. I'm sure. Again, guys, this is these are podcasts that are just talking about ideas. We don't go too in depth on stuff. And I know we've talked about how there's different types of accounts out there that help you grow your money and stuff like that. And some of those we've talked about how they can be cash value life insurance products, but there's different ones. And if that's something that interests you, for us to do a whole new episode, because those are too many things to go into on those. So if that's something that interests you, just message us, comment, let us know, because we want to talk about what you guys want us to talk about. And like I think we've mentioned on previous podcasts, if it's something we don't know about, we can do our research. That way we learn together. Because this is wealth building for dummies, and we both are dummies too. So we want to learn as you guys learn too. So let us know.
Awesome. And thank you guys for tuning in to another episode of the Wealth Building Podcast for Dummies. I almost got my words mixed up there. Wealth Building Podcast for Dummies. I'm your host, Kyle Demian. We were joined by Renji Matthew today. You guys can follow us on social media at our links, which will be in the bottom corner of the video here. And until next time, we'll see you guys later.